Welcome to Talk Tickers, where we break down the complex financial ideas that are actually moving the needle in investor portfolios.
Today, we are focusing on a pretty sophisticated strategy that is really changing how people think about passive investing, especially for those in, higher tax brackets.
Yeah, we're going way beyond the traditional wrapper of ETFs and mutual funds here.
We are.
We're taking a deep dive into direct indexing. And this isn't just some trendy buzzword. It's a powerful tool that offers you, the investor, unprecedented control, customization, and what amounts to a measurable, repeatable edge in maximizing your post-tax returns.
That's the key phrase, post-tax returns.
Exactly. So our mission today is to cut through the complexity and explain exactly how it works, why the technology is finally making it accessible, and where this strategy really delivers the greatest value in a tax-efficient portfolio.
To start, let's just define the mechanism. Direct indexing, or DI, is a strategy that aims to replicate the pre-tax performance of an index, let's say the S&P 500. But instead of buying a fund share, the investment manager actually purchases the individual underlying securities for you. This is all done through a personalized portfolio wrapper, something called a separately managed account, or SMA.
Right, an SMA. So the core idea here is it's simple but kind of revolutionary. Instead of owning a tiny slice of a massive shared fund, you own the actual basket of stocks.
You have direct ownership. That's the heart of it.
And that ownership, that's what unlocks these two huge benefits.
Yeah.
Customization and what the industry calls tax alpha.
That's right. When we talk about customization, we mean, the ability to tilt your portfolio. Maybe you want to avoid certain sectors for ESG reasons, or maybe you just personally can't stand the tobacco industry.
You can just screen it out.
You can do that seamlessly. But the quantified benefit, the tax alpha, that's what truly separates this strategy from everything else.
And when we say quantifiable, we mean big numbers. The simulations we've looked at suggest DI strategies are, something like 3 to 5 times more tax efficient than a comparable index tracking ETF.
3 to 5 times. It's a massive jump in efficiency.
It really is.
And that efficiency comes directly from the ability to harvest capital losses at the single security level. That's something that's completely impossible inside a pooled fund like an ETF, which just gives you one price for the entire basket.
Okay, I have to stop you there, though.
Duh.
Because if the tax efficiency is 3 to 5 times better, why is the resulting gain when you apply it to a high tax bracket investor in U.S. large caps? Only around 10 basis points per year.
Right.
10 basis points, it sounds like a rounding error, not some huge disruptive force.
Yeah.
Help me connect the dots between that huge efficiency number and the, seemingly small return boost.
That is a critical question, and it really reveals how we should think about DI. 10 basis points is small in absolute market terms, but this isn't market alpha, this is after-tax alpha. So the 3 to 5 times efficiency, that refers to the volume of tax losses you can generate. But the value of those losses, that depends on market conditions, tax rates, and so on. What we're really talking about is a predictable, repeatable, positive boost to your after-tax expected return.
So it's not a bet, it's an optimization.
Precisely. In a market where generating even 50 basis points of true active alpha is incredibly difficult, an extra 10 BPs of post-tax return is essentially a guaranteed performance bump just through better structure. It's low drama, high certainty value add.
I see. It's about securing the base return and then optimizing the real outcome in your pocket, not chasing some risky market bet.
Exactly. And that edge is rooted in the fundamental mechanics of how that separately managed account operates.
So walk us through the mechanics then. If I'm used to just buying one ticker for an ETF, what does buying into an SMA actually look like?
It means that you, the investor, are granted direct legal ownership of every single underlying stock chosen for the portfolio. Think of an ETF as buying an expensive, well-tailored, off-the-rack suit. It fits most people well enough.
Okay.
The SMA is the bespoke tailor. It's built just for you.
So I own the actual stocks. But if I'm tracking the S&P 500, am I now holding all 500 individual securities? That sounds like an administrative nightmare.
And that's where the smart technology comes in. Because replicating a massive index stock for stock is cumbersome and, frankly, often unnecessary. So what managers typically do is employ a technique called thoughtful sampling.
Sampling.
Yeah. They might only hold, say, 40 or 50% of the constituents, the largest, most representative holdings, rather than needing to buy every single one.
So how do they make sure that those, say, 200 or 300 stocks actually track the performance of the full 500?
They use highly sophisticated portfolio optimization processes, and their whole goal is to minimize trapping error to the reference index. Tracking error is just the difference between your portfolio's return and the benchmark's return.
And in direct indexing, you want that error to be as close to zero as humanly possible.
As close to zero as possible. This optimization process is constantly running, looking for the best mix of securities to hold while freeing up the manager to execute the tax strategy.
This is a great segue into the history of this, because for decades, this kind of customization and, sophistication just wasn't available to regular investors, not even wealthy ones.
Oh, absolutely not. For decades, this strategy was strictly reserved for institutional investors. We're talking giant pension funds, the ultra high net worth crowd.
Yeah.
You often needed a minimum investment of $1 million, $5 million, even $10 million.
It was the exclusive club of investment management.
It really was.
So what broke that barrier? I mean, how did we go from $1 million entry fee to something closer to, $250,000 today?
It's a classic technology disruption story. Two major innovations really paved the way. First was the maturation of unified managed account platforms, UMAs. These allowed advisors to efficiently manage hundreds, even thousands of these individual SMAs all at once.
So it brought the administrative costs way down.
Exponentially. And the second piece,
Was it?
fractional shares.
Okay.
Historically, if Apple traded at, say, $180, you had to buy a full share. If you're building a diversified portfolio with 300 different stocks, having to buy full shares just meant your minimum investment ballooned really quickly.
Right.
Fractional share technology means managers can buy $100 of Apple, $50 of Amazon, $37.50 of Google. It allows for precise index tracking, even with a much smaller capital base.
That truly democratized the process.
Mm-hmm.
But let's get into the engine room here. Tax loss harvesting, or TLH. This is the heart of tax alpha.
Yeah.
How does owning individual securities enable this unique tax benefit?
It all capitalizes on a concept called dispersion. Think about the S&P 500. Even during a strong bull market, let's say the overall index is up 15% for the year. Well, maybe 30% of the stocks in that index are actually flat or even down. They're dispersed from the average.
So the tide is rising, but not every boat is floating equally high.
Exactly. And because you have direct ownership, the manager can look into your specific account and identify those individual securities that have lost money, even if your overall account value is up 10%.
Wow.
They can sell that loss, immediately recognize it for tax purposes, and then swap into a highly similar security, a sister stock, to maintain the portfolio's market exposure and keep that tracking error low.
That's the key distinction, isn't it? If I hold an S&P 500 ETF, the ETF itself has to be down for me to realize a loss. And that loss only happens when I sell my ETF shares.
Correct.
With DI, the manager is realizing these internal losses for me constantly, even in up markets.
That's right. And when they do sell that stock at a loss, the manager uses a very specific lot selection policy. They employ what's called least tax first out, or LTFO. This basically dictates that when they sell a security, they choose the specific share lots, the ones you bought at the highest price, to maximize the realized capital loss.
Which means maximizing the tax deduction. Now, this sounds a lot like active trading. I mean, we're talking about constantly selling and buying new stocks. How is this different from a high-fee active manager who's trying to outperform?
This is the critical distinction that often confuses people. In active management, trades are driven by security fundamentals. The manager believes stock A will beat stock B.
Right, they have a thesis.
In DI, trades are driven purely by optimization. The manager's goal is twofold: maximize realized capital losses and maintain consistent low tracking error. They are not trying to generate market alpha at all.
So we have two types of tracking error at play here.
Yes. In DI, we are aiming to keep what's called unrewarded tracking error low. This is the minor necessary deviation that happens because of the TLH transaction or the sampling. It's like a small vibration from running the optimization process. You don't get paid for it, but it's essential for the tax benefit.
Whereas active management is all about rewarded tracking error, taking intentional, high-conviction bets that they hope will pay off with true market alpha.
Exactly. DI is indexing first, tax efficiency second. The whole strategy is about improving the post-tax return of an already established market return. It's not about security selection or market timing.
That makes perfect sense. So if the mechanics hinge on dispersion and efficient loss capture, who is the ideal client to take advantage of all this complexity?
The optimal environment for DI is very specific. First, it absolutely must be held in a taxable account.
Of course.
The tax benefits are completely moot in tax-deferred vehicles like IRAs or 401ks where gains and losses are shielded anyway. You need to be paying current capital gains taxes for this system to work for you.
And second, it's best for really efficient asset classes, right? Markets like U.S. large-cap core equities, where it's notoriously difficult for active managers to beat the index consistently.
That's the sweet spot. If the active manager can't generate enough pre-tax alpha to overcome their high fees and the tax drag, DI just swoops in with its quantifiable lower fee tax savings and wins the after-tax race pretty much every time.
Efficiency plus taxability.
Yeah.
Okay, let's move beyond just harvesting losses. The SMA structure, because it's a personalized account, it allows for some incredible strategic planning that an ETF just can't touch.
The customization elements are massive. I mean, beyond simple ESG screens, you can tailor a portfolio to accommodate a client's existing concentrated position in a single stock.
The classic golden handcuff scenario.
Precisely. If an executive has a huge block of stock from a grant with a near zero cost basis, selling it all triggers a massive taxable event. A DI strategy allows the manager to gradually manage that transition, using tax losses generated elsewhere in the portfolio to offset small gains from that slow liquidation process.
So it manages that transition incredibly tax efficiently over time.
It does. It's also great for incorporating existing appreciated holdings without forcing an immediate sale. And it's a huge tool for charitable planning. It supports tax-optimized giving by letting clients donate their most appreciated individual securities directly from the SMA,
which minimizes their tax liability while maximizing their philanthropic impact. It's a really sophisticated planning tool inside a passive strategy.
It is.
Naturally, this sophistication demands a lot more attention and comes with unique challenges compared to just holding one ticker symbol. What should a listener be aware of regarding implementation?
The management of these portfolios is complex. It requires regular, active maintenance. An ETF might rebalance once or twice a year. DI portfolios need constant attention. Rebalancing is triggered not just by time, but by drift thresholds.
What's a drift threshold?
It's when a specific security weight, or maybe a sector exposure, deviates too much from the index, or when there's an index reconstitution event.
For instance, if a big stock like Tesla gets added to an index, the DI manager has to immediately adjust the holdings in, thousands of different SMAs?
Exactly. That operational complexity is built into the fee. And another big limitation is the international market. While DI is fantastic for liquid U.S. equities, it's much more complex for international equity indexes.
How is that?
Liquidity. That's part of it. But it's largely a reliance on American depository receipts, or ADRs. You can only easily own and trade individual foreign stocks if they have an ADR listed on a U.S. exchange. This really restricts the universe of securities available for replication and tax loss harvesting.
So it makes the strategy less effective globally. Let's circle back one last time to the quantifiable benefit and the role of time. We established that higher tax brackets increase the efficacy, but does the benefit last forever?
The benefit definitely rises dramatically with higher tax rates because the value of the deduction is proportional to your marginal rate. But no, the benefits are not infinite. They tend to diminish somewhat over longer investment horizons, usually around 7 to 10 years.
And why the expiration date?
Because if the market is consistently rising over that decade, the pool of unrealized losses available for harvesting just shrinks. The manager uses up the losses. You're left with a portfolio that's highly appreciated. And while you've benefited a lot in the short to midterm, the opportunity to generate new tax losses gets harder and harder.
You've successfully monetized the tax drag.
You have.
Okay, let's unpack this for the listener one final time. We established that direct indexing provides quantifiable tax alpha and some amazing customization benefits. This strategy is clearly powerful, but those benefits, they always come at a cost. Greater complexity, potentially higher management fees than a cheap ETF, and increased administrative oversight.
Right. So here is the one question you should always ask when you're considering this strategy.
Given that tax efficiency is its primary quantifiable benefit, what is your threshold for acceptable management fees and portfolio complexity relative to the estimated annual tax alpha?
And this matters because the strategic benefit only holds if that crucial 10, maybe 15 basis points of after-tax gain consistently outweighs the negative drag from higher fees and administrative effort. If your fee is too high, you might as well have just bought the ETF.
Today, we performed a deep dive into the mechanics and quantifiable benefits of direct indexing. We've covered its personalized structure as an SMA, the source of its unique tax alpha through security level TLH, and its sweet spot in the efficient taxable equity market.
And remember, while DI really started in the institutional world, technological advances have truly democratized this sophisticated tool. It can really enhance after-tax outcomes, particularly for high tax bracket investors struggling with efficiency in U.S. core equity.
We encourage you to use this knowledge to evaluate whether the after-tax savings unlocked by direct ownership justifies the necessary complexity and the increased fees in your own portfolio construction. It's a trade-off that is definitely worth calculating.
We strive to provide you with the most essential nuggets of knowledge to help you optimize your portfolio strategy. Thank you for joining us for this deep dive.
Until next time, keep optimizing.